you're unknowingly sabotaging your equity growth. Most investors are losing millions due to simple mistakes. Building wealth through equity investment is a goal for many, but achieving it requires more than just picking the right stocks. According to Harvard Business Review, understanding the pitfalls that hinder growth is crucial. By recognizing and avoiding these common mistakes, investors can set themselves up for long-term success. So, what are these mistakes and how can you avoid them? The first mistake is lack of diversification. Putting all your eggs in one basket can lead to significant losses if that sector experiences a downturn. Diversifying your portfolio across different sectors and asset classes can help mitigate risk. For example, investing in a mix of tech, healthcare, and consumer goods can provide a safety net. Furthermore, diversification should also consider geographic regions to capitalize on growth in emerging markets. A well-diversified portfolio is the foundation of long-term equity growth. The second mistake is emotional decision-making. Fear and greed are the enemies of successful investing. Making decisions based on emotions rather than data and analysis can lead to selling low and buying high, directly impacting your equity growth. A disciplined approach, sticking to your investment strategy, and avoiding impulse decisions are key. Additionally, understanding market volatility and having a long-term perspective can help investors ride out short-term fluctuations. Overlooking the power of compound interest is the third critical mistake. Starting to invest early and consistently can significantly impact your equity growth due to the compounding effect. For instance, investing $1,000 a month from age 25 to 65 can result in a much larger sum than investing the same amount from age 35 to 65, due to the extra decades of compounding. This highlights the importance of early and consistent investing. The fourth mistake is failing to monitor and adjust your investment strategy. Market conditions and personal financial goals can change, requiring adjustments to your portfolio. Regularly reviewing your investments and rebalancing your portfolio as needed can help ensure you remain on track to achieve your equity growth goals. This might involve shifting between asset classes or sectors based on economic trends and forecasts. Perhaps the most overlooked mistake is not leveraging tax-advantaged accounts for your investments. Utilizing retirement accounts such as 401(k)s or IRAs can provide significant tax savings, allowing your equity to grow more rapidly over time. Additionally, understanding the tax implications of your investment decisions can help minimize tax liabilities and maximize your returns. This strategic approach to taxation can be a powerful tool in accelerating your equity growth. Now that you're aware of these common mistakes, what steps will you take to avoid them? Achieving explosive equity growth is within your reach by recognizing and avoiding these critical mistakes. Remember, knowledge is power, and applying it to your investment strategy can lead to significant financial gains. Stay informed, stay disciplined, and watch your equity grow over time. Thanks for watching, and we'll see you in the next video.